Okay, I think that's good enough. We can start with the quorum. Good morning and welcome to the CDSC SLB webinar series. If you're joining us for the first time, CDSC has been running webinar series monthly. This is our fourth webinar series, and the topic for the day is understanding securities lending and borrowing. We shall be looking at the risks and the mitigation measures that have been put in place by CDSC to ensure that all the participants in the product are protected. If you are joining us for the first time again, please remember that you can find the previous webinar recordings on our YouTube platform at CDSC Kenya. And yes, I know my name is Steven Atema. Some of you are expecting Hilda. I promise you this was not planned. Hilda was not able to join us today, and she sends her apologies, but I'll be taking you through the day's discussions. So thank you again for joining. Remember to tell your colleagues or friends that the webinar is on, and you can, for those who received the invite links, you can also share to your social media or your relevant platforms. A few housekeeping rules for the people who are joining us for the first time, or even the attendees. You are joining a webinar, so probably most of you, your audio systems or your mics will be mute. So we would request you that in case you have any questions, concerns, clarifications that you need, to please post it on the Q&A section or the chat section. We have a team that will be at hand to assist you on the queries. And in case you still feel the issues have not been well addressed, if time allows, we can have it during the Q&A session with the panelists. So thank you again for joining us, and thank you for making time. I'll go straight ahead and start with our panelists. Today we have three panelists. The first panelist for the day is Mr. Abed Mureidi. And Mr. Abed has been the principal actuary at the Actuarial Services East Africa Limited, abbreviated as ACSAV. It's an actuarial consultancy firm that has operated for over 20 years. He is a fellow of the Institute of Faculty of Actuaries in the UK and has more than 15 years experience in actuarial industry, having worked in Kenya and South Africa. In his career, he has been advising clients throughout Africa and outside in areas of pension, insurance, and investments. Previously, before joining the Actuarial Services East Africa, he worked as a lecturer at the University of Nairobi. So thank you, Teddy. You could wave for the audience, or if you have any remarks, you can share.
Hi, it's Abed.
Sorry.
Thank you very much. I look forward to an engaging discussion. Thank you.
Thank you, Abed. Now, Teddy, the actual Teddy. Teddy is a senior investment analyst at CIC Asset Management Limited. He has over 9 years experience in the financial services sector, 7 of which were in the investment banking and asset management. Teddy holds a Master's of Science in Finance and a Bachelor of Commerce, both from the Bachelor of Commerce in Finance, both from the University of Nairobi. He is a certified public accountant, a member of the ISPAC, ISIFA, and is a CFA Level 2 candidate. Teddy, please wait for the team. Sorry for the miscommunication in the details. Teddy?
Good morning, everyone, and happy to be in this webinar. We hope that we are going to have an engaging webinar. Thank you.
Thank you very much, and thank you for making time to be in the panel. Sorry. Our next panelist, who will also be the speaker for the day, is Mr. Francis Kibathi, who heads the risk management function at CDSC. Mr. Kibathi has over 12 years experience in audit, risk, and compliance, having previously worked to various capacities, both as an internal and external auditor. He holds a Bachelor of Commerce degree Finance from the Kenyatta University and is a certified public accountant, certified information systems auditor, and a member of the Association of Certified Fraud Examiners. He is currently pursuing his Master's of Science in Finance at the University of Nairobi. So Francis, you can wave to the team, and because you'll be the presenter of the day, you can just share your screen so that we can start the day's session. Thank you again. I would request the other panelists to please turn off your mics, as well, to turn off your screens so that we can see Francis's presentation. Thank you, Francis. Take it away.
Okay. Thank you, Steve. Thank you, everyone. And good morning. Good afternoon, where you are logging in from. Here in Nairobi, it's quite chilly. but I'm hoping that the engagement here that will be able to warm up us up as we engage, specifically discussing things to do with risk management for this new novel product that CDSE is putting in place. And of course, what we'll be discussing here would be the risk management for SLB, what the mitigation measures are as they have been put by CDSC, and of course, how then, having understood what those measures are and the risk exposure, then participants, especially the investors, lenders, and borrowers, then can be able to take opportunities under the SLB product. So just to start us off, I'll give a brief about SLB. And by definition, SLB is the temporary transfer of shares from one party, who is the borrower, to another, from the lender to the borrower, with, of course, an agreement to return the shares either on demand at any point that the lender would want to recall the securities, or at a future date that will be agreed upon, of course, within a period of 1 day and 365. And this SLB is open to a number of participants, and this can be either individual or institutions that hold shares, of course, on a long-term basis. That is the basis upon which then they can be able to lend their securities within the period that they would have defined. So how to lend or how to borrow securities under SLB? You can contact your SLB agent. Then you submit your lending or your borrowing request based on the criteria that you have. For example, the quantity that you want to lend or borrow, the period, the fee that you'd like to be paid or to pay. And then upon confirmation of availability of the shares on the lender side, then that lending request is captured in our CDS system. And from the borrower side, if we have sight of the collateral, then we can then capture the borrowing requests. Then on the lender side, then the security shall then be reserved, and the lending request added to the lending pool or matched with any existing borrowing request. Again, that applies to the borrower. And remember that when you key in or when you provide a lending or a borrowing request, there is a certain time frame that you want that request to expire, assume matching has not happened. So in case that matching doesn't happen within the time frame that you had specified, then the request will automatically be removed from the lending or the borrowing pool, and the shares will be released. The same with the collateral. So in terms of benefits of participating in SLB, starting with the lender side, of course, there is the additional income through the lending fee, so that you can then enhance the yields that you'll be getting by holding these securities. Then in terms of the process is automated of the transfer of the securities, and therefore there will be no manual contracting and agreements that will be put in place, so that then you can lend out the securities. The process is automated. Then by regulatory requirements and by nature of the product, the lender receives all the corporate action and all the economic benefits that take place during the period that the SLB transaction is running. On the borrower side, again, there is additional income in the bear market, because the understanding here is that when you come to the market, you want to borrow when the prices are high, and then return the security when the prices are low, so that then you can make your additional margin income. Then the product also supports certain investment strategy, like short selling, which, for example, then can even be used to meet securities obligations for the borrower side, especially if they have an outstanding obligation to meet in the cash market. On both sides, we are saying that there is no counterparty risk, simply because when a transaction matches, a lending and a borrowing transaction matches, then CDSC stands in the middle to guarantee settlement or meeting of obligations of the participants. That, for example, the lender will get back their securities, and the borrower, of course, will get their collateral back. Then of course, the lenders and the borrower will transact on a common platform, as opposed to a situation where you have bilateral transactions that would require a borrower or a lender to look for each other. So what we're saying here is that the CDS then provide a centralized platform where these transactions can take place. So to get deep into securities lending and borrowing, I would first highlight the few agents that we have already appointed. And these have actually been projected on your screen. So if your agent is, or your broker or your custodian is here, then you are ready to start the process of lending or borrowing in the market. And if not, then this can be a very good opportunity to be able to contact your broker or custodian if they're not listed here, so that then they can be able to facilitate you in with regards to the lending, securities, or borrowing, and participating in the SLB. So before I go to SLB risk management issues, I'd just like to highlight here that management of SLB risks is done within the overall enterprise risk management framework for CDSC. And this framework is benchmarked on, acceptable global standards, like the COSO ERM framework. We have CPMI IOSCO standards for risk management for financial market infrastructure, and you also have ISO standards. This is ISO 31000, and the latest one is ISO 31000 2018. So it provides certain principles broadly classified into 5. Of course, looking at the governance, and we are saying for CDSC, we have a very adequate oversight mechanism of risk management through the board's audit and risk committee, and periodic, assessment of risk by the management team, the executive committee of management. Then we are also saying that we also promote, an organization-wide culture of, risk appreciation, just to ensure that risk management is well-defined and mitigated. We also have, as part of that, there is an understanding of the business context within which we operate and operationalize SLB. And the board has also defined what our risk appetite and tolerance is with regards to risks that CDSC can take, and also including the issues to do with SLB. It also defines within that framework our risk, assessment methodology with regards to identification, analysis, evaluation, and reporting. And with regards to that, then we have identified broad categories of risks that we do manage. I'll not be able to go through them because some of these are, are company-wide. I'll focus specifically on those risks that are specific to SLB that would be of importance for the people who are attending this webinar. And some of those risks, of course, include the credit or the default risks, liquidity risks, operational risk, legal and compliance, market risks, and custody, collateral custody, and the agency risk. Because remember, we are appointing SLB agents, and therefore they pose certain risks to us as CDSC or to the market participants who are the underlying lenders and borrowers. Now, delving into the specific risks, I'll start with the credit or the default risk. And of course, this is a risk that a party, either a borrower, a lender, or CDSC, will be unable to meet its fund or securities obligations when those obligations are due. And you are saying, for example, here that CDSC features here because they stand in between to guarantee performance of obligations of the lender and the borrower. So there are certain risk exposures that I will be highlighting and the mitigation measures that we have put in place. The first one, of course, is the issues to do with collateral. And we are saying that the borrower could fail to provide collateral at the beginning of the contract, or the lender may fail to provide securities when we are starting the SLB transaction. And in this regard, we are saying that for your borrowing request to be accepted or to be input into a CDS system, you must have provided the collateral, and CDC must have cited that collateral. And therefore, upon citing that collateral, then we can approve your lending request to join the lending pool that we have. Again, on the lender side, if you want to lend, when you give us your lending request, we must ensure that the securities that you are intending to lend are unencumbered, meaning that The security should not be earmarked, for example, for settlement or for pledging for a collateral or have been frozen for one reason or another. And the moment that happens, if the lending request and the borrowing request have been matched based on the criteria, for example, on the securities that is under consideration, the quantity, the lending fee, then the moment that transaction matches, then there will be simultaneous blocking of the collateral by CDSE and the transfer of securities to the borrower from the lender, so that then the issue of settlement risk doesn't arise again because of that simultaneous execution of the two transactions. The second aspect is a situation where the borrower fails to honor the additional call margins. Remember, we'll be doing as part of managing market risk what we call daily marking to market of the transactions. For example, securities that have been borrowed will be marked based on the prices that have been given by NSE at the end of the day. And again, if we have non-cash collateral, then you also do the same, just to ensure that the balance is there between the value of the borrowed securities and the collateral that has been provided. So if the borrower fails to do that at the end of the day or when the obligation is due, then we will start the process of closing out the contract. Of course, the understanding here is that we want to limit the exposure that we are putting on the lender, because the lender at any given moment, based on the regulations that have been put in place, needs not to lose their shares. So if the borrower fails to meet the obligation with regards to margin calls, then we start the process of closing out the contract just to minimize the quantum of the exposure. Then the other aspect is failed delivery, especially on the part of the borrower, when they fail to return the securities to the lender at the end of the contract period, or when those securities have been recalled by the lender, or because of the default of the borrower to meet the margin calls, CDSE starts the process of closing out the contract. So failure to deliver those securities, we are saying that we will use the collateral that has been provided. Remember, the collateral is at 100%, and it has been marked to market. So it is the current value, it is based on the current value of the securities. So we use the collateral to acquire the securities in the open market. And if you're not able to do that in the open market, then we can, in coordination with the NSE, go to the buying board. On the buying board, you buy securities at a premium, as in you, so you sell securities at a premium, so that we have a motivation for the people who are selling to you to provide as many as possible, just to quicken that process and to reduce the period within which we can be able to acquire these securities. So we'll go to the buying board and acquire these securities and pay them using the collateral that has been provided. Of course, if you're not able to, we have made best effort as the central party and you're not able to provide the securities, then we can do a cash equivalent compensation. And this compensation again happens at the current market prices, so that the lender at any given moment doesn't lose on the default of the borrower. Then the other obligation, for example, the lending fees or manufacturer dividends, I'll discuss that a little bit later. And if the borrower is not able to meet that obligation, because the lending fee has to be paid to the borrower, first, we will use the collateral provided as the first line of defense. If that collateral is not sufficient, because, for example, we first used it to acquire the securities that the borrower may have defaulted on, then we have put in place a settlement guarantee fund, which is currently up and running, just to ensure that those obligations then are met by CDSE as part of their role in guaranteeing settlement of these transactions. But of course, that obligation that the guarantee fund has incurred is still part of an obligation that needs to be honored by the borrower to CDSE. With regards to liquidity risk management, we are saying that as part of the exclusion of the risk is that the risk is where a counterparty fails to settle an obligation for full when it is due. Of course, the understanding is that you may not be able to meet it now, but you can do that later. So we are looking at this in two aspects. The first one is to do with the stocks or the securities that are eligible for lending and borrowing. And we want to ensure that these securities are as liquid as they can be. And that's why the regulations or recommendation from the Capital Markets Authority is that as we, we start launching this product, we limit those eligible securities to those that are within the NSE 20 share index. And these, anyway, are the most liquid within those that are available at, at the NSE. And of course, there could be a few, 2 or 3, that are not as liquid as others that are outside. But if you're looking at the most liquid securities, you'll find them within the NSE 20 share index, and that is the basis upon which we have restricted or limited eligibility. If a lender would like to terminate a contract, we would require that a lender gives a notice of 14 days to the borrower, so that then the borrower can have time to go to the market and source for these securities and to make them available to be returned by the date or the revised date that the lender would like to receive their securities back. So that again will help in mitigating the issues to do with the illiquidity of the stocks that are there. And of course, if because of illiquidity, you're not able to get these securities, then again, as I said about management of credit risk, we'll still do a cash compensation to the lender in case of default by the borrower. The second aspect is to do with collateral that is provided. And we also want to ensure that collateral is also as liquid as possible to ensure that when we need to use it to meet the borrower's obligation to the lender, it is readily accessible. And if the borrower has met all the obligations with regards to SLB, we can again easily return it back. And that's why then, therefore, we have restricted collateral currently to cash and bank guarantees. There are also systems in place. We are putting a framework between us and the central bank because they're the custodian of the government securities to again allow the borrowers to pledge government securities, treasury bills, and treasury bonds again to be used as a collateral. And we are saying that these are liquid because of the rediscounting window that is available at CBK, so that if you're not able to get a market for T-bill and T-bonds, then we can easily exploit the treasury bills and bond rediscounting window. Of course, with the adequate haircut that will be applied when that has been put in place. Again, if these collateral has been provided to CDSE, there is again restrictions in the rules and regulations on how CDSE can reuse or rehypothecate these collateral. So if it is in form of cash, we want to put that in an interest-bearing account that is also liquid. And that's why for the start, we are saying that we'll put this cash collateral in a call account. And if it is government securities, then we can only participate in overnight repo when we have put that framework for pledging of government securities. In terms of operational risks, and these are risks that relate to loss to the participants resulting from inadequacy in the internal processes that you put in place, the people that you put in place to support the SLB framework, and the system, the automation that comes with it. So with regards to the process, we are saying that we already have put in place rules and operational procedures. These operational procedures were exposed to the market at the time that we are starting to launch the product. And upon that, the regulator also reviewed the adequacy and they approved them to facilitate, the launching of the product. So there are adequate rules and, procedure guidelines for that. We are also saying that for participants to appreciate the level of risks, the obligations accruing to them, then we'll be doing periodic communications to these parties, their agents, and the regulator, just to ensure that they appreciate their level of exposure. And there are also rules and within the contract that we have provided adequate indemnification mechanisms so that if there would be flaws within the processes that we have put in place for SLB, then a party that loses stands compensated by the party that has occasioned that loss. So that if SLB, because of fraud, errors, or miscommunication, then an agent or a lender or a borrower loses, then CDSE stands to compensate the party who has suffered that loss. With regards to accounting treatment, because it's a question that I think has been asked in a number of meetings that we've had, there are quite adequate guidelines in IFRS how the accounting treatment for SLB happens. And just as a guide is that an SLB transaction is a transaction where the risk and rewards remains with the lender. And therefore, the assets with regards to the reporting, accounting for that transaction, those assets still remain with or are reflected as the assets of the lender. Of course, the borrower on the other side will have to record an obligation to return these securities, but the IFRS provides adequate guidelines for that. In terms of systems, we are saying that we've already automated the SLB framework by putting in place a new and revamped CDS system that has already been tested by the market participants, both during the development of the CDS and currently with the live transactions that we are seeing. Again, we have done a lot of benchmarking on what you're calling the centrally cleared, SLB transaction, and this was done in various markets, for example, India and Brazil, and we are therefore sure that the screen-based, what you're calling the centrally cleared SLB, is a model that is adequate and has been tested elsewhere and is, of course, working as we compare that with the bilateral model of SLB. In terms of our capacity, and I believe this is part of this initiative, we are continuing to, of course, offer training and capacity development, both internally and to participants, just to ensure that they appreciate the framework within which screen-based SLB works. The other risk is legal and, of course, compliance. And legal issues, deal with, contractual terms for SLB transactions, the regulations that have been put in place, court orders that might be issued with regards to security transactions or voiding of certain contracts. And we are saying that with regards to regulations, there is already securities lending and borrowing and short selling regulations that were issued by the Capital Markets Authority. And based on that, CDSE also went ahead and designed the rules and operational procedures, which have already been exposed and approved by the regulator. And again, just to ensure that the regulator is confident about this product, CDSE was admitted in CMS regulatory sandbox to be able to test or pilot live the screen-based SLB, so that if there would be any gaps within the regulations that are already been issued prior to the launch, then the regulator then can put in place adequate gaps, measures to seal the gaps that will be identified. In terms of the regulator's support, we are also saying that there is a requirement that SLB should be carried out by regulated entities who then can act as SLB agents. And these entities include those that are regulated under the Capital Markets Authority, the Central Bank of Kenya, the IRA, RBA, and such. So that if you fall under those, then you can easily be admitted as an SLB agent. Then the other part, especially since we are looking at pension schemes being participants with regards to the lending of the securities that they hold for long term, RBA issued a letter of no objections to these retirement benefit schemes to allow them to participate in SLB, but subject, of course, to the provisions that are within their investment policy statements. We have also put in place master agreements, and these agreements are between the lender and the borrower, on one side and their agents, and between CDSE and the agents that you would have appointed to act for this product. Of course, those then spells the obligations, responsibility, the dispute mechanisms around that, just to ensure that there is adequate legal protection of the participants and they appreciate their responsibility as they participate in screen-based SLB. Having said that, there are other risks that I would also want to highlight. The other one is to do with the custody, and specifically the custody of the cash collateral that is given to us by the borrower as the central party. And we are saying that if cash is provided, that cash will be deposited in a tier 1 commercial bank with a low credit risk rating. So this risk rating is one that has been developed internally, in addition to augmenting that with the external credit ratings that we receive or are issued as and when they are issued for the commercial bank by institutions like Moody's, S&P, and the rest. Then again, to limit the risk of insolvency or receivership, as what we have seen and experienced before, that collateral, again, if it is in form of cash, will have to be distributed among these tier 1 commercial banks, just to ensure that in case a default happens or an insolvency happens, then one bank doesn't go down with all our collateral. So it will be distributed based on a credit distribution and ranking mechanism that has already been developed by CDSC. In terms of settlement risks, which specifically here we are talking about the delay in receiving securities and collateral, we are saying that at the point where lending request and borrowing request matches, there is no time for that a lender or a borrower will wait before they get the counter value. What that means is that when that transaction matches, securities move immediately and collateral is also blocked immediately, as opposed, for example, the situation that we have in the current cash transactions where settlement is on a T+3 cycle. This is immediate. In addition to that, if there are certain obligations that would arise that either the borrower doesn't meet, then you have put in place the settlement guarantee fund just to come and cover that overexposure that is not captured or well consumed by the collateral that has been provided. With regards to market risk, because we're dealing with a marketable product, we have said that we'll be doing marking to market, and this will be done on a daily basis, both on the securities and non-cash collateral that has been provided, so that if there is any mismatch in between, we do a margin call so that then the borrower can be able to top up. Again, what that means is that if the prices are going down, for example, the committed collateral is also released in the system, and the borrower is at liberty, especially in managing the credit risk that is posed by CDC as the central party. They can be able to withdraw that collateral so that they can minimize that. In addition to that, we have also put in place an initial margin requirement, and that's why you hear us talk about a collateral of 110%. The 10% is an initial margin that then helps in mitigating the market risk or the price fluctuation risk that would happen, and ideally the participants will be exposed to. Of course, I've also talked about the limitation on the use of the collateral so that we don't get the cash and then as CDS central party, we start going and investing these cash all over the place. And therefore we expose unnecessarily the borrower and the lender to the market risk. Having said that, there are certain, and we are saying that CDC, of course, has put in place adequate measures. There are certain aspects that both parties, especially the lender and the borrower, needs to appreciate as they engage in the product. The first aspect is to do with the market, the timing, especially on the borrower side, that the market might as well go against the borrower. Because the understanding is that if you want to make money in SLB, you need to borrow when the prices are high and take a bet that the prices will go down at the point that the contract comes to an end. So that if that doesn't happen, then you'll end up finding a situation where you'll make a loss simply because there are no margins to be made. And therefore, the borrower needs to appreciate this. And it is not that they don't have mechanisms to mitigate. Because a borrower here, we're saying that is a very risk-aware person, needs to put in place probably what we are calling risk, appetite and tolerance levels, so that if the prices are escalating to a point that beyond that tolerance level, then they can terminate the contract. And it is provided in the rules that the borrower can terminate an SLB transaction at any given time. So that then works in favor of the borrower in managing, that adverse price movement. Then there is the issue of the dividend declaration. If the borrower has a running or an outstanding transaction, then in the event that dividend is declared and the book closure happens when that transaction is still running, then the borrower would be required to manufacture dividends and pay to the lender. Because remember, the economic benefits of a lent security has to revert back to the lender. So if you don't time that transaction adequately, then that exposure might happen so that you end up spending more. But again, there is, of course, dividend declaration does just happen like abruptly, and the book closure again is always weeks, if not months down the line. And therefore, the borrower still has an opportunity to be able to realign and get themselves out of these situations, or to appreciate if, for example, the value of the declared dividend is within the margins that they expect to make, then they can allow that contract to proceed. The other issue, of course, the premature winding up of contract, or either on call by the lender or on default on the margin calls. And therefore, this might happen at a point where the borrower had not realized the margins that they were expecting, and therefore end up, of course, not being able to realize those benefits when that contract is prematurely terminated. Of course, there's an element of the liquidity, but again, we are saying based on the securities that are eligible for lending and borrowing, we don't see this happening. And again, even within the eligible pool, the borrower has to make the choice on which securities that they would want to participate in, so that if they consider certain securities within the NS20 share index to be illiquid, then they can stop participating or fail to participate in those, and then only choose those that are considered to be liquid. Of course, there's the element of the delisting and suspension of securities. And again, when that happens, it means that there is no market for those securities. And if you are borrowed, it means you cannot buy back the securities returned to the lender. And in that situation, therefore, we'll be able to use the collateral that you are provided to compensate the lender. What that means is that, we have the collateral, but you also have the securities, either which you are holding or which you had liquidated, and therefore you have the cash equivalent. And therefore, there will be, in terms of loss, there will be, other than, because this is, mark to market, there will be no element of loss, because we are only using the cash equivalent of the value of the securities that you have borrowed to compensate the lender. And again, on the lender side, we are saying that that compensation will happen at the current market price, so that again, they also don't lose. And focusing specifically now on the lender side, a lender could be holding certain transactions for strategic purpose. And when they lend the securities and the borrower fails to return the securities, and CDSC as the guaranteeing party is also not able to get these in the open market or through the buy-in, then we'll do a cash compensation. Cash compensation means, therefore, that you lose that strategic control. But that loss, the probability of that happening is also very low, because one, the securities are liquid. It will be the default or failure by CDSC to get the securities is very minimal. And if that was to happen anyway, because these securities are quite liquid, the period for reacquiring that strategic control will also be shortened, because you can easily go to the market and reacquire these securities back. Remember, I also talked about, especially managing liquidity, that the lender needs to give a 14-day window for the borrower if they want to recall these securities. That 14-day window then, therefore, means that if there's certain time-sensitive information, or opportunities that the borrower would like to, the lender would like to exploit, then that might not happen, especially if the borrower takes their sweet time to return the securities on the 14th day. Again, premature winding up of the contracts or return of the securities mean that the revenues that you had, for example, projected, if you had lent for a period of 1 year, then they are returned 9 months down the line, there is 3 months period that you don't earn, you might not be able to earn the revenue. And again, we are saying that currently, as as we run the the product, they might not be able to get an immediate borrower again. But as we progress, we'll have a very robust situation where if securities are lent, you submit the same securities immediately for lending, so that then the only risk that you are exposed to here is that you might lend your securities now at a lower rate than what you had before. But of course, again, it might also work in your favor that the market is quite liquid and there is demand, and therefore you lend for the remainder of the period at a rate that is higher. So you'll allow me to stop at that point, and probably just leave you again with a list of the already appointed SLB agents. These are brokers and custodians that you can use to exploit these noble opportunities to be able to enhance your yields as the lender and to be able to make margins as the borrower. Thank you very much for listening. I take you back to Steve. Thank you.
Thank you, Francis, for your detailed presentation on the risks and the mitigation measures that have been put in place. And thank you for the audience for the queries and clarifications that are coming through the chat. So please remember that you can share your chats on your questions on the chat section, and they shall be addressed by our team. I think from what the presentation that Francis you are sharing, as an investor, we appreciate that there is always risk for any investment opportunity that you seek to take advantage of. And I believe what CDSC, what we are trying to do is just to assure you as an investor or as a participant in the SLB that while there will be risk as will be in any other type of investment, CDSC has done its level best to ensure that all the risks that are identified have appropriate mitigation measures that have been put in place to safeguard all the participants involved in the product. So should you have any queries, also I'm sure there might be also some concerns about with the risk, what about the reward? So we had done a previous webinar about the possible or opportunities that would have been available for participants. So in case you need to have a view of the potential returns that an investor would have made participating in securities lending and borrowing, you can just go to our website at www.cdsckenya.com, and you will see a presentation that was made on the financial gains to be made for all participants, both lenders and borrowers in the SLB platform. So thank you again, Francis, for your presentation. And as you see on your screen, we have so far 7 approved SLB agents. So you can reach out to them for SLB engagements. You could also find this list on our website again at www.cdsckenya.com. So based on the presentation that has been shared, I would like to engage you, the audience, to just give your thoughts about what risks that you feel, based on what Francis has shared, are likely to materialize in the near future, so that we can start our discussion on the types of risks that have been identified. And Francis can also give us his presentation or his thoughts on the types of risks that will have been identified, as well as whether the polling by the team or the audience will be sufficient. So I think you should be seeing a poll on your screen about the types of risks that you feel would be likely to materialize. So please just spend a few seconds to vote so that we can go to the next discussion. Thank you. The panelists, you're also welcome to vote. Thank you. We are about to close. Just a few seconds remaining. Remember to answer both questions, question 1 and 2, and we shall share with you the results. Our servers are open. Thank you again, and thank you for those who have voted. So you should be able to be seeing the results on your screens. So based on the votes that came in, it seems the market is not so much concerned about the credit risk and the liquidity risk. Though the percentage is high, they are mainly concerned about the market risk of that as the main risk likely to materialize, and the least risk likely to materialize is legal and compliance. So maybe Francis, we can talk about that as we start the discussion. And for your opinion, I believe that 63% of you feel that indeed CDSC has put in place sufficient measures to address these risks that have been identified. And we can assure you that in as much as what Francis has listed is what has been identified so far, as new risks arise, they are going to be addressed, and the information or the measures that have been made public to the participants, just to ensure that all the concerns or all the issues that they might have are well addressed. So thank you again, and we seem to see that a clear winner here is market risk. So I would ask the panelists to just open their cameras and their mic so that we can start our discussion. Thank you, Teddy.
Thank you, Steve.
Thank you. So yeah, just from the foot of that audience feedback, Francis, you are the subject expert in all matters relating to risks, regard to SLB and anything else. Do you feel that the audience, or do you agree with the audience that the risk that has been mentioned as market risk as the highest likelihood risk to materialize? What do you feel is the actual likelihood risk to materialize, and how have we dealt with this type of risk? Or are you in agreement with the audience?
Yes, thank you, Steve. I think that the people have spoken, and and I agree, because you know, the issue of price risk or market risk is of a concern, of course, with regards to, again, the other aspect of default. But I think default has actually well been addressed. You know, the credit risk, but that actually mirrors what our concerns at CDSE has always been, and therefore that is how, again, you have put in place certain you know, mitigation, just to ensure that that risk, especially for the price fluctuation, is actually addressed. And with regards to that, based on the presentation that I've just made, it's the number of steps that we have put in place, that because there is an exposure on lending marketable securities, we do a day-to-day daily mark-to-market on the lend securities and the collateral, if it is a tradable collateral. So that happens, and of course we do a margin call. But of course, at the initiation of this contract, or through the period that the contract is running, we have also put in place what you're calling the margin requirement, just to help in mitigating that specific risk, and that currently has been set up at 10%. Now, how do we quantify, especially in CDSE, that market risk? There are quite a number of you know, models that we use for that, and one that is widely used in the market is, you know, the value at risk model. And recently we have seen, and especially with what happened in 2008, the fact that we need to enhance that, and that's why, you know, we have come to what we call the extreme loss model, the loss over and above the value at risk model. So there are certain parameters that we'll be looking at, of course, the daily volatilities, the period that we think that the market exposure will be there. For example, when we start, when you do a mark to market today, the borrower has up to tomorrow noon to deposit additional margin. Failure to do so by the end of tomorrow, we start the process of closing out the contract. And remember, when you do a mark to market, you're comparing the price at the end of day today and the price yesterday. So you're talking about 2 periods of exposure. And of course, there's the liquidity that if we go to the market and we're able to get within 1 trading day, then there could be a third additional day. But working with a period of 2 to 3 days, and the volatility that we have in the market, and a certain element of confidence that you want to give to the market. Currently, the standard that we prescribe, we subscribe to the CPMI OSCO standard, recommend a minimum of 99%. If you look at that level of confidence, then we quantify that risk based on those parameters, and we get a margin of somewhere close to between 10 and I think should have been 11, if it's that, no, 10.5. And in addition to that, just to ensure that we are the 10% is adequate, you also do back testing, so that we look at the price history or the experience that has been within a given period of time, and we do a look back and just see, assume there would be a default, how would the experience look like? And based on the test that you have done, I can give assurance that the margins are within the 10% range, and of course, given the confidence of 99%. But of course, if the margin of 10% is not sufficient, then remember I said you talked about the guarantee fund, that if the loss is over and above the 110%, the guarantee fund, which has been set up by CDSE, comes into play to help and absorb the extra risk. So with regards to its management, I can say that we have adequate tools to quantify that risk and to assess the adequacy of that quantum. And if, for example, we missed a step and the exposure is over and above what we had anticipated, we have put in place additional resources to be able to absorb that risk, so that the lender doesn't make any losses with regards to that. Back to you, Steve.
Thank you, Francis. I think anybody who was concerned about that market risk should be well assured that indeed, in as much as it's a highly likelihood risk to occur, there are measures that have been put in place to significantly minimize the exposure to participants. So Teddy, just on the talking from what Francis is saying, do you feel that there are some of the risks that he has highlighted that could be different from what you are experiencing in the market for other products, not necessarily related to securities lending and borrowing, that could likely also apply to CDSC's SLB product?
Well, thank you, Steve, and CDSC for hosting these monthly investor engagement programs and for inviting CIC to be part of these programs. I think the presentation that has been done by Francis has been well elaborate. It's covered all angles of the risks that we could face as participants in these securities lending and borrowing. However, I think there are some risks that could fall under or sub-risks, which I think if maybe Francis has gone through them, maybe he could still chip in to maybe give the remedies if possible, if they're there. From our end, I think what we'll be looking at, first we suppose that there is the default and collateral investment risk, which I think are the most rampant risks. So under that, we first a risk called the replacement cost risk. And this happens in case of a default. And this default could come in different ways. It could be temporary or it could be permanent. And in the situation whereby this default is permanent, and it happens that one of the mitigation measures is that collateral has to be used to pay back the lender, then I think there's an issue of the lender having to effect a buy-in. That means to purchase the securities that they had loaned in the open market. And if it happens that during the date of default and the time that the collateral is cashed and a transaction is initiated to buy these securities in the market, we could find a price mismatch in the sense that we may be having prices that have gone way higher than when the transaction was in or when the collateral was cashed. In some instances, you find that especially for portfolios that hold pension funds or insurance funds that are long-term in nature, you find that now onboarding that security could be a bit of or could say it's not visible because the price has gone significantly higher. So here you've lost in terms of the cost, and then again you have your strategy that has also been disrupted, because remember you're having this security for the long haul. You were not intending to get rid of it anytime soon. So there is an element of realignment that has to be done. The other thing that maybe we could encounter in our operations or as we engage in securities lending and borrowing probably is there's the issue of if securities are transferred and as Francis has mentioned, there's the issue of maybe dividends and other benefits that have to be reverted back to the lender. And then again, there's the issue of transfer of rights. I believe if the securities are loaned, the rights are transferred to the borrower at that point of loaning. So when it happens that there is key issues to be voted on and the securities are not transferred back to the lender, then we will see that maybe the lender could lose out on those voting issues. This will happen, and in fact, if I put it in the picture, the aim of securities lending and borrowing, and especially to our end, will be to generate extra revenues for the client. And if we focus on that, sometimes you may find that maybe the focus on the key voting issues moves away, and sometimes it can bypass some of these participants. So what measures do we have in place that will make sure that these key issues are highlighted at the particular point in time that they arise, and that the the clients' interests are put in front such that they don't lose out on some of these issues. And the other things that maybe we'll look at is, well, the mitigation measures have been well elaborated, and I think we commend the structures for that. But looking at the custody risk, first, we have the issue of reinvestment, and it's been highlighted that reinvestments, it has to be in securities that are quite conservative, such that they can be realizable anytime. However, what happens if probably the custodian goes insolvent or becomes negligent or participates in fraudulent activities? The measures we put in place, we've made sure that such things won't happen. But in the unlikely event that these things happen, what are the remedies that are attached to that? I think from our end, that will be quite insightful if we can have it from Francis. But all the same, I think looking at the structure of securities lending and borrowing and what has been put in place by CDSC is quite robust, especially on mitigation. And I think this decade, as opposed to the previous decade, I think we've been, the measures have well been improving. And I think the conservation effect has taken a front line compared to the riskness that it was there in securities and lending, borrowing and lending. Over to you, Steve.
Thank you, Teddy, for those elaborate risks that you have highlighted. And I think, Francis, without further ado, you can just address them. I think he raised 3 issues. I believe you noted them down. You can just address them one by one for the benefit of CIC and other asset managers. Thank you.
Thank you, Steve. And I'll handle them one by one because luckily these are issues that CDSC is quite alive to. And starting with the first issue of about replacement cost and the cost that a lender would incur, for example, in reacquiring these securities when there is default, we are saying the margin that we're talking about that had already been set up in place is to absorb some of these. We are talking about the trading cost, because if you go to the market, for example, and you want to buy these securities, you have to incur certain transaction fees. There is if you're not able to get the securities, we go to the buying board, and remember the buying board, you sell at a premium. There is a cost to that, and then there is also the issue of the the bid-ask spreads with regards to liquidity. So those are things that are done within and are incorporated within that margin. Remember that we have a standard margin of 10%. It is not, for example, in a situation, for example, if you look at the derivatives where a margin is set up as per security or as per the product that is being we are transacting on in the derivatives market, and therefore the margins are different. You are talking about a standard rate for the 20 NSE 20 share index, and therefore within that averaging, of course, there are securities that have or would attract very low margins, and there are those that would attract higher than 10% margin. So those are within that, and of course we are saying out of that transaction the lender is not supposed to make any loss. So there will be compensation for that out of the margin cover that has been provided. With the issue to do with the voting rights, remember when of course you have an AGM and you need to exercise certain rights, there is a period that is required either for the issuer to give notice, and that notice, if I'm not wrong, is not less than 21 days. Within our own framework, we are saying that if you want to exercise a certain right as a lender, you can recall these securities and you need to give a notice period of 14 days. So within that period, if you wanted to exercise your rights, and that is relevant to you as an investor, then you can be able to give a notice and the securities will be returned to you within the period or within the time that or as at the time that the AGM will be taking place. And again, we're saying again, these securities are liquid and therefore it will be very easy for that to happen. With regards to custody risk and specifically the returns that we are getting, remember it is as has been said rightfully, there is a a balance between the risk, the liquidity risk, the credit risk, and the return that you would want to give back to the borrower. And in this situation, we are saying that we will promise a return, because in other markets that we've done the benchmarking, the collateral, the returns on the cash collateral is never given back to the borrower. And neither does the central party, and in this case, for example, CDSC, promises that they will invest that collateral. So what we are saying is that if you give us cash collateral, we will invest it. And we'll invest it in those securities or those products that have very low risks. And that's why, again, guided by the regulations that we can only have this in interest-bearing accounts, we put this in an interest, in a call account, we have earn a certain return, and that return is given back to the borrower. But again, remember that the moment you borrow securities and then you sell them, you get the cash equivalent. It's like, ideally, CDSC is holding only 10% of your collateral because you have the 100% with you after selling. And you can use that cash to invest in higher return products based on your, your risk appetite. You can go fixed deposit, you can go to the market, you can go GOK securities, and be able to get a return or to compensate for the returns that you would feel that CDSC is and investing this collateral in low interest account, as opposed to where you want to have those securities put in place. So these measures and strategies have actually been well articulated in our operational procedures that are available, as you had said earlier. Thank you.
Thank you, Francis and Teddy, for those remarks. I believe, Teddy, some of those or all those concerns have been addressed by Francis, and they should give you and the other fund managers in the audience some sense of assurance that indeed, in as much as they might not have been specifically highlighted in the presentation, we are alive to those risks and we are providing mitigation measures just to ensure we address those for your comfort. Teddy, just to bring you can mute your mic so that we can continue. Yes. So Abed, just to bring you to the discussion, you as an actuary in the industry, you play a significant role by helping the fund managers and the pension schemes to try to advise them on the investments that they can take on behalf of their clients. So based on what Francis has shared and even what Teddy has added, do you feel that there are some similarities between what risks SLB will face and any other type of investments that are currently being engaged on by the pension schemes and fund managers?
Yeah, thank you, Steve, and thank you to the CDSC. First is just to congratulate the CDSC, and of course, I'm sure with the other regulators on this product. It's very, very innovative for our market, and I can see the beginning is on, of course, the stocks and share securities. Just to mention, currently, share portfolios of pension schemes are in the region of about 218 billion Kenya shillings, and this was by a report by the RBA, Retirement Benefits Authority, as at 31st December 2020, and we can see clearly from the pension scheme side. There are the aspects of lender and borrower on the SLB, and perhaps from where we sit, we would think that perhaps pension schemes would serve as very good lenders of securities in this kind of space. Looking at the borrower side, of course, the borrower side seems to be an aggressive side where you're looking to make some kind of arbitrage profits or enhancement of profits. But from the pension scheme side, it does seem like a lender position would be quite interesting. And specifically because of the enhanced returns that could just be achieved on through the lending fee that the lender would charge. And just from our own experience, we do know that pension schemes are long-term holders of securities, They hold them through bull runs and bear markets, and therefore, and the ability to just earn some extra return out of this definitely is a positive. Definitely, of course, there is also the aspect of to what level are. I'm just looking at some of the issues that maybe would be there from the pension scheme side, is in terms of understanding the product and appreciating it and appreciating how it can provide some enhanced return would be one area. And I believe through this uh, webinars, it would be quite educative for trustees. And as well, of course, fund managers definitely are within the spheres of CDSE circles and would be able to hear a bit more. But generally, yes, it would be one area that we would look at. Just in terms of the risks, of course, there is that market risk. One, I think significantly is the loss of opportunity for the pension scheme to trade in their shares and take advantage of opportunities. It might not be, so that is when they have lent. It might not be so much of a big problem, especially given they will be dealing in the larger shares, the NSE 20 shares, where you find that they are not very heavy traders as pension schemes. Um, so it may not necessarily be a big concern for them as they're able to hold even through bear markets. Though there is, of course, that significant credit risk. I don't know, that's no, sorry, a liquidity risk that could arise in case of suspension of of uh, of a share or when it gets delisted. Maybe those would be some of the concerns. Perhaps the 14-day window to recall a security could be quite interesting for pension schemes to avoid this kind of liquidity risk, though they may not be as swift. Of course, they're very dependent on their fund managers. Market risk again, I think there is a very we would even assess this kind of product as being low risk for pension schemes, simply because of the collateral aspect. We think that is a very strong selling point for pension schemes to consider this kind of opportunity. Um, Another, of course, issue is can pension schemes really become, active players as borrowers and seek to have much higher returns than just what a lender would receive? Perhaps yes, though pension schemes generally are less aggressive in their investments and may not want to be too speculative. But nevertheless, I believe out there in international markets, we find that pension schemes are willing to also have aggressive investment strategies that would include short selling and acting as borrowers in this kind of market. So I think those would be just some of the initial comments, and even just touching no wider than just more than the risks. I think there's also something important that has also maybe would need to be clarified by Francis. I think had something to the effect that the Retirement Benefits Authority has issued a no objection for pension schemes to participate in SLB, and that, of course, in the investment policy statement, they would just require to include SLB transactions as part of the investment policy. Perhaps that would be quite interesting. I think some of the other issues have also been clarified. Corporate actions to the benefit of the lender, so they do not lose out on their dividends. Perhaps one is on the guarantee fund that has been set up. To what level does it provide? I think from the understanding is that it protects on the lending fee, but what about on even the actual value of the securities? So in case, say for example, the custodian becomes insolvent. I think that would be maybe one area that would be maybe a kind of question that could arise. What would happen also in the event, for example, There are government securities that have been uh, that have been used as collateral, um, and perhaps say the government. We are saying this is maybe a remote event, but perhaps say the government would want to defer settlement on some of these government securities or defer interest payments and that kind of thing, and there is and there is loss of value, and the borrower is not able to settle on their portion of the margins. What happens in that case? Does a guarantee fund come also in such cases, or is it strictly limited to the lending fee? I think that would be the one additional item. Thank you very much.
Thank you, Abed. Just like said, these questions are quite interesting, and Francis, you have to help them address these concerns, because they are very valid concerns, and coming from the players who are experts in the industry, it helps us to clarify. But overall, I believe what Abed is saying, that the risks that he has seen being highlighted in the SLB product are more or less what risks they would face in investing in other products. Maybe the technicalities would be different, but they would still face similar market liquidity credit risks participating in the different products. So maybe Francis, you could just briefly try to help him clarify on the how the guarantee fund would help address the other concerns he has raised, as well as the expanding on the RBA no objection that CDSC received last year. Thank you, Francis.
Okay, thank you, Steve. And I would respond as follows. Of course, it's comforting, to see the value of the transactions or the potential transactions that can be lent out from the pension funds. And again, the appreciation that the pension funds hold these assets for long term. And therefore, a borrowing window of between 1 and 365 days is one that, pension fund can easily participate and therefore enhance their yields. Because whichever case, if the prices are going up and you get a return, you enhance your yields. The prices go down, you still enhance your returns by adding earning additional income with regards to SLB. And again, now specifically to the issues to do with the no objection letter. So that was one of what we call a very fundamental achievement for achievement of strategy that we are trying to pursue with regards to SLB, because from where we sit, we see pension schemes or retirement benefit schemes, of course, participating as lenders, but nothing stops them from playing on the borrowing side. And that's, I think, an appreciation that has already been said, that nothing stops a pension fund from being aggressive. So you can have a fund just to pursue, active investment and aggressive investment in products like these ones on the borrowing side. But on the lending side, we are saying that, of course, there's always a concern, a question by trustees, by administrators, by fund managers, whether there is need for their regulator, the RBA, to make certain pronouncements. And that is how we ended up pursuing these, so that we would elaborate how the product works, how it benefits the retirement benefit schemes. And it is upon that that the RBA was able to issue that no objection letter. Of course, the RBA again appreciates that there are certain, especially with the crafting of the investment policy statements, there could be either based on experience or out of risk aversion that they would restrict certain activities. And that's why, therefore, the RBA is saying you are free to participate, subject to the restrictions that you have put upon yourselves in your investment policy statement. So that no objection was issued, and it has already been shared with the relevant potential participants. And we believe therefore that the steps that they are currently undertaking is to review those schemes if they do not allow, or if they do allow SLB kind of product, then they can then put in place mechanisms through the various parties involved to start participating. The second issue about the guarantee fund, we are saying that guarantee fund is not the first line of defense. Okay, so first we start with the collateral. So And the collateral we are saying that is at 100% with a top up of 10% on the initial margin just to cover margin market risk. So that if that is not sufficient, then we default to the second line of defense, which is now the guarantee fund. And of course, the understanding is that 110% would largely cover based on the market volatilities, and the aspect of marking to market would be able to cover the principal securities that have been borrowed, so that these additional the obligations like the lending fees, the manufactured dividends, then can easily be taken up by the guarantee fund. But again, I don't think there is nothing that stops us within our framework to again be able to tap into the guarantee fund to meet an obligation that has not already been met by the collateral. What we are saying is that CDSC as the guarantor would ensure that the lender doesn't lose. That's it. Back to you, Steve.
Thank you, Francis, and thank you for addressing those concerns by Abed as well as Teddy as they have been raised. Just before you end, have you seen, based on the risks that you have highlighted, has CDSC seen those risks materialize, if any, and what were the mitigation measures that were put in place if they have arisen?
Let me start by saying that we have put in place adequate mitigation measures. And then number two, we have had transactions that have been entered into and concluded successfully without any of the risks materializing. And we also have current, what you're calling active SLB transactions. And some of them are on these big tickets like, KCB, Safaricom. And you can see, for example, that with the announcement of, the entry into Ethiopia, that there was a lot of activity on Safaricom counter. But again, based on our mitigation measures that we have put in place, we have not seen a situation where any of those risks have materialized. The volatilities around that have actually been absorbed or are within the collateral that had been provided, by the borrower. And other than that Safaricom issue, generally the market volatilities, we tend to experience these bouts during, corporate action announcements. And we have seen at least relatively low volatilities. And therefore, exposure to market risks have been there, but have been absorbed within the collateral that has been provided and are within the margin estimates that we have put in place of the 110%. With regards to liquidity, again, we have seen people participate in these very liquid securities. In addition to that, collateral that has been provided has been in the form of cash. And therefore, based on that strategy, it will be very easy for us to be able to meet an obligation arising from the default of the borrower, especially when that relates to the lender. And again, entry into these with regards to legal provisions, we are seeing that we have done all that is required with regards to contracting, and we have seen successful entry and exit into those transactions. But that in any way doesn't mean that a risk can't materialize. There are things might happen, because remember I said we are in a regulatory sandbox. You have no idea what the CMA would come with to in terms of the assessment. There would be improvement definitely with those regulations. So those changes again, might come in a situation that might not favor certain parties. But currently, as we stand, the risks and the measures that we have put in place to mitigate those risks have actually helped in ensuring that we have not seen a situation where those risks have actually materialized for the concluded and currently active transactions. Back to you.
Thank you, Francis, again. I'll just go to Teddy, and out of the risks, the measures that Francis has highlighted as having been addressed, as well as the questions you posed and the answers is given, CIC being one of the largest asset managers in serving both corporate and individual investors, I'm sure you're always looking for returns for your customers. So do you see SLB as a platform or a product that you would be keen on investing in the near future to boost your returns for your customers?
Well, as you already mentioned, SLB increases the range of revenue enhanced measures that we can explore, and as such, definitely CIC Asset Management will be eager to engage on that. However, it's good to note that CIC Asset Management manages a range of client funds from pensions, insurance to unit trust funds, which are guided by the respective investment policy statements. These policy statements actually are designed in a way to factor in the risk return profile of these specific funds. So currently what is happening is we are in consultation with the trustees to see how SLB can be incorporated in these policy statements. And now that probably we have Abed in this webinar, maybe he can enlighten us because as SLB comes on board, there are also some questions that maybe could linger. For example, can we then incorporate SLB as a different asset class, or it's part of the existing asset classes? If then again it has to be incorporated in the IPSs, does it also would include that maybe a certain lending limit be mentioned in each respective risk return profile of the plans? That will maybe be put in place to maybe just say you can't engage in SLB past a percentage of the AUMs that you have in place. So I think from our end, we are quite ready to engage. However, we are guided by investment policy statements, which are currently in the process of either being reviewed or in consultation with the trustees to get approvals to engage in it. So maybe probably I'll pass it to Abed to give us or to enlighten us on the way forward, or how is it supposed to be incorporated in this IPS.
Thank you, Teddy. And Abed, before you just proceed, I think you could also highlight on the investment policy statements and if indeed Teddy as well as other clients, how they would go about it, and if there might be even need to change the policy statements, or they can go as is based on the no objection from the RBA. Thank you, Abed.
Thank you very much. I think for us as ACTSAF, definitely there is a SLB is a new kind of opportunity. Yes, the RBA has issued the letter of no objection, but nevertheless, they have not yet updated their guidelines to to specify whether the SLB should be a separate asset or not. In this case, what would typically happen is we would include a provision on the extent of portfolio of either the equity portfolio that can be utilized towards SLB. SLB in this case lending as an aggressive, if they are to participate as borrowers, this one would need to be specifically an opportunity presented by the fund managers for consideration by trustees to be included as an aggressive investor as a borrower. But as a lender, it would be a restriction in terms of to what proportion of the equity portfolio would be available towards SLB lending. I think those would be the comments I would make. In terms of investment policies, typically investment policies last 3 years. So a lot of times you will find that it is on the renewal when you would start including new types of opportunities. For maybe larger schemes who are quite aggressive around their investments, they may want to include as addendums before the 3-year period is complete. And that is generally how it would work from the investment policy side. Thank you.
Thank you, Abed, and I believe Teddy and all the other asset managers can also take guidance from Abed from AXAV on how they can go about the reviewing their IPSs to align with SLB. Before we conclude, I would take maybe 3 or 2 questions from the audience that maybe Francis or Teddy and Abed, you can help assist. There is a question here from Michael, who is asking what will be the basis for lending fees, and is the interest market determined? Francis.
Thank you, Steve. The basis is, and I think he has actually answered that question. It's market determined. You come to the market, you want to lend at a certain fee. You come to the market and you want to borrow at a certain fee. So if those matches, whether you want to borrow at 5%, 10%, 2%, and someone wants to lend around the same range, if it meets certain criteria, because if you want to lend from, let me say, 5 upwards, and someone wants to borrow at maybe 6%, definitely there will be a match. So it's market determined, just as you go to the market currently to acquire like Safaricom shares. You say mine is this price, that's what I'm willing to pay, or this is what price I'm willing to accept. And that's how it works. It's literally, ideally market determined rate.
Okay. Thank you. Thank you. Any other comments from the team? I think the other questions can be addressed on the chat section because we are running out of time. And for all the participants in this webinar, we shall be sharing this presentation as well as the Q&A section for you to familiarize yourself with on the questions. So maybe Francis, you can start with your ending remarks as we come to a close.
Okay, thank you, Steve. For me, I think it would be very simple, and because I sit on risk, it is the assurance that I would like to give that we have put in place measures to address the risks that especially the lender, the borrower, and their agents would or may suffer. And these have actually been well articulated in our rules and operational procedures. So it's to give the assurance that they can participate on the appreciation of those risks, so that then they can be able to take up these noble ideas, especially for the lender to enhance their yield, and on the borrowers to take, earn margins by taking a bet on, prices moving down and other benefits that comes with borrowing of securities, for example, to meet even settlement obligations. And anyway, it's to re-emphasize that assurance, and to ask participants who are here, potential lenders and borrower, to start actively participating, because we currently have transactions that are live. So you don't want to be left behind, because given, for example, analysis I was doing recently, that compared the price on 1st of April and the closing price yesterday, more than, let's say, 50% of the counters experienced a decline in price comparing the 2 dates. And therefore, there is an opportunity for people to exploit here, either based on short-term and those long-term periods. So don't be left behind. Thank you.
Thank you, Francis. Thank you again for your presentation and your apt remarks on the different risks that had been highlighted. Abed, maybe you could also briefly give us your closing remarks.
Yeah, thank you very much. Again, I think, as I mentioned, this is a very innovative product for the market. And I would say, speaking from the pension side, definitely it is an opportunity that would be very, very eye-watering for pension schemes. Just to highlight, it just enhances return. It is a return enhancer for pension schemes. The aspect of collateral really makes it a low-risk kind of investment for pension schemes. And we believe that it is a good innovation and would be very beneficial to the pension industry. And I think the CDSE has done quite good work to really cover a lot of the risks. and I think it's a well packaged product. Thank you very much.
Thank you, Abed. And on behalf of CDSE, we take those remarks and we aim to improve and improve your experience as well as on the different investors that we serve to offer products that are up to date with what the market needs. Teddy, please give your ending remarks.
From my end as well, I would just like to commend CDSE for putting up this product and incorporating the risk mitigation measures that are in place, that which I can say are quite robust. SLB is a product that is there globally and it's been generating a lot of big revenues to investment funds and investors. And now that it is here with us, I think it's upon us as the investors to take advantage of it and enhance our returns. So I will urge all investors to take the product positively, and also to CDC probably to increase or extend these investor engagement programs, probably to even the trustees, such that the whole engagement captures all players in the industry. That would be it from me. Thank you.
Thank you again, Teddy, Abed, and Francis, for the time you took to come to this webinar event. I would like also to thank you for the audience for your patience and your questions that were addressed on the chat section as well as live. We come to a close of the webinar session, and we would like to thank you again for making time to be here. For those who are not able to attend, we shall be sharing, you can inform them that we shall be sharing the link to the presentation as well as the different information about regarding SLB to the emails that registered for this event. Thank you again, and have a good day.